The Quantum Group USA, LLC in California, DBA Quantum Distribution and Insurance Services. Advisors are responsible for following all insurance, DOL, FINRA, SEC, broker-dealer, and compliance officer approval requirements prior to distributing this information to clients. Well, welcome back. It's another exciting edition of More Market Insights. And as we talk about the first half of the year, it's been, I would guess, anything but predictable. Investors have navigated persistent inflation, evolving Federal Reserve policy, geopolitical tensions, and significant shifts beneath the surface of all the markets. While major indexes in June were relatively unchanged, a closer look shows us meaningful sector rotation and changing opportunities. And here to talk about what I just said, just to break it down, is Andy Moore, Quantum's Vice President of Advanced Planning and Portfolio Solutions. And as we do this once a month, the first off is your prediction on oil prices was 4 months ago was pretty correct. But I'm going to start with the Reserve, the Federal Reserve. So we're kind of jumping into a new monetary policy, but what does this new era mean to investors? I mean, what should they be concerned about, or how is this helping? Or hurting?
I don't think they should be concerned about too much. It's definitely going to change transparency. I think Kevin Warsh is coming in, and he wants to go back to kind of the era of a Greenspan, we'll call it. No, he's got a couple of challenges right out of the gate. You know, you still have the former Chairman Powell sitting on the board, which is almost unprecedented. We did have a Supreme Court ruling yesterday that Trump can't fire a Federal Reserve as of yet. So it was a close vote, 5-4, a little closer than I thought. And Powell said he was going to stick around for that. But going back to the Fed as it is, inflation's still a little sticky right now. Oil prices have collapsed for the most part with the ceasefire, the MOU that's in place. We hit 68, 69 a couple of days ago. I think when you look at what he's going to try to do, he actually has a talk at the ECB tomorrow, Wednesday. Today's Tuesday, so not quite July 1st yet. But we'll see how that media coverage goes. But I think when you're looking at the challenges ahead, and for the retail investor, if you want to know what the Fed's going to do with interest rates, it's not a true tell, but just watch a 2-year Treasury. 2-year Treasury spiked a few weeks ago, which tells us the smartest money on Wall Street, which is the bond market, anticipates Fed hikes. Mm-hmm. Right now, the dot plot has 2 hikes by the end of the year. I don't think that's going to happen. We have midterms coming up, which I think we're going to talk about. I don't think he does anything, in my opinion, before the midterms unless we actually have more runaway inflation. I don't think oil, which is probably transitory on the inflation side. Maybe you get one after midterms, call that November, December. But those that were anticipating any rate cuts, they're a long ways off, in my opinion. So back to your original question, I think communication is not going to be as much as it was with Powell and his Fed, where almost every week you had a Fed governor speaking in front of CNBC or Bloomberg, or a paid appearance, whatever it is. They're going to, I think, go by the numbers. They're going to change kind of how, we put a committee together, I think, to look at, half a dozen different ways the Fed operates. So I think you'll see changes to the Fed and how they operate going into 2027. He does have a tough task with Trump probably breathing down his neck for rate cuts. Hopefully they can stay independent more so than they have been. But yeah, it's going to be a transition that'll be probably fun to watch and see what direction he goes. Come January 27, if we're still doing this, right, we can look back and say we were either right, wrong, transparency, Fed, taking his foot off his throat, so to say, for rate reductions. But just keep an eye on the 2-year Treasury. That'll probably tell you what the Fed's going to have to do.
And we've had, which is normally a great sign, is wage growth, right? But that also will impact inflation. It can. Is this a good thing, or is it just could be potentially another inflation booster?
So wage growth is good. We'll have the June jobs number Thursday, being Friday is a holiday. So keep an eye on that job growth. The reason I don't think it's inflationary to a degree, consumer spending has still been really good. Where you think with everything that you hear on TV, the consumer's dead. Prime Day, which is 4 days now. Imagine twice a year you have Prime Day, but they're 4 or 5 days at a time. Record numbers for them at a Prime Day, so the consumer spending is still good. The negative part of that is a lot of it's going on debt, credit card, but they're still spending. So you need wage growth to keep the consumer going. So as long as we have that wage growth, unemployment, 4.3, 4.4, keep it from escalating over 4.5 to 5, we're in pretty good shape when it comes to the economy and jobs.
Yeah, and the index is kind of flat, but there's sectors that are performing. What are the sectors that are making the most difference right now?
So we've talked about it there's a massive rotation underneath the hood. The individual investor probably doesn't realize it. The advisors that work with Quantum, probably see it. There are some bear markets out there, and as Warren Buffett always said, there's always a bull market somewhere. You just have to find it. We've mentioned software stocks since fourth quarter of last year. They still can't get out of the way. They had a 1 week rally, but if you look at Microsoft, Oracle, Salesforce, down anywhere 40 to 60%, that's a massive bear market. Mag 7 until yesterday was down about 14% for June. But when you look at Microsoft, Meta, Amazon, Google just got beat up a little bit. They're down anywhere from 20 to 40% as well. So the market you would think would be down a lot more than within 2-3% of all-time highs. The rotation's been consumer staples, healthcare has found a bid. Small caps has outperformed the S&P by 20% year to date. So big divergence when you look at small caps, which is really the underpinning of the U.S. economy, right? Small businesses. So small caps, and we talked about that probably a year ago, that we would look at the IWMs inside the fixed index annuity. Not too many carriers or products have it, but those that did, we were allocating to that. So when you look at the market as a whole, it's amazing that we are where we are, knowing that the Mag 7 software is down. Really the stick save was semiconductors. So a few months ago when we said semis were at a critical support level, it either breaks and all hell breaks loose, so to say. Those stocks have rallied anywhere from 50 to 200-400%. So thank God for the semis to kind of keep us where we're at, but it helped with the market rotation. The other thing that you kind of look at, which we've talked about late summer going into midterms, possibly a bigger correction, which probably would feel like a bear market. Hedge funds are almost fully committed to investments, equities, most of it's tech. Margin debt is at its highest level. So if there's going to be an unwind going into the end of the summer, early fall, the recipe is right for the picking, so to say.
All right. So let's talk about the Middle East and talk about Iran. There's this quote-unquote ceasefire, which apparently is always pretty messy.
Yeah, the MOU.
Yeah.
There's no understanding, but they have it.
It's interesting to say the least, but I mean, let's go back to 4 months ago when you said oil would be back down into the 60s, and well, here we go again. Nostradamus. But let's talk about the Middle East. What are the risks that still remain? Because I think things are, obviously we can move oil now and it's loosening up a little bit, but that doesn't make me feel any better right now.
Yeah, I think you just told yourself the answer. It's the Strait of Hormuz, right? How much does Iran want to control? That's their leverage in this whole thing, which, going into the war, you probably thought it was all about nuclear bombs and whatever else they were talking about. But, what has come out of, this, few months of fighting with Iran is that they do control that strait. If they want to charge a fee, they just shut it down. That is Trump's biggest, pain right now. Pain point is how they're going to settle, the Strait of Hormuz and how much oil can flow through there. Right now, in my opinion, not being a expert on, the wars and everything else, there's going to be an agreement that the right's going to think is feasible, and then the left's going to say it was Trump giving in and not a good resolution. But if they can't figure out how to play fair and nice in a sandbox, this could drag out for months and months and months. So Trump's in a predicament right now.
Oh, yeah.
I think with the MOU that's in place, we did catch a bid a couple of days ago. There was some fighting over the weekend. So you can just see how fragile the markets are. If cargo container or oil container gets hit with a drone and there's retaliation, it can go on for a while, but I don't think you're going to see oil spike above that 120 unless it really escalates. So again, I think we're in a good place. We just don't know how long it's going to last.
Yeah, I mean, ceasefires, as I said, are always messy. It's like, you can tell he really wants this thing to end right now. It's like, oh, they bombed a cargo ship. Yeah, it's like, oh, that's okay. It was a mistake. Yeah. It's fine. So investors, July, here we go. Second quarter earnings, potential guidance from the Fed at some point. Which is the most important? Or what should we be paying attention to?
So it's always, in my opinion, it's always earnings and how well the companies are doing. Just look at whether it's second quarter or the second half of the year going into 2027. First half was a little bit more bullish than I think a lot of people had foreseen with where the markets went, especially with the war going on. Right, oil was elevated, but when we look at going into the second half of the year, earnings will kick off in the next week or two. What we talked about a couple months ago was how good the first quarter earnings were, and everyone raised estimates. I actually wrote them down. So at the start of 2026, the S&P earnings were 309. So that's what Wall Street's best guesses were for all 500 companies in the S&P. It now stands at 341. When you look at the 2027 revised estimates, beginning of 26, we were at $351 a share for the S&P. They're now at 400. So we always talk about forward price to earnings ratios, right? So if you look at, if we were to be at 400 on 2027 S&P, the market trades in 18 times forward earnings, which is pretty cheap. We would probably look back a year ago when we were doing this, we were probably, if I remember correctly, 24, 25, 26 forward earnings. And we talked about that's probably a little rich. So we've had this earnings compression on the prices of the S&P 500 stocks, but we've had a huge expansion of potential earning estimates from Wall Street. So right now the market is fairly priced, if not a little bit cheap. Tech stocks, we'll have to see if we can get the software and the Mag 7 to come back. But the rotation's healthy. We probably are higher at the end of the year. 2027, third year of a presidential term, is always the best of the 4 years. So I do think there's some tailwinds ahead of us to have a good year end, 2027. Maybe too early to talk about 2028, but the market's fairly priced for success. So we'll see what happens in the second half of the year. Hopefully second quarter earnings that'll kick off in the next week are still robust. AI spending, I think we touched on it. $900 billion, almost $1 trillion from the Mag 7 going into infrastructure. That's bigger than most G20 GDPs. So there's a lot of onboarding domestically that, credit to Trump and his administration. It's the most that any presidential's ever seen. Obviously, the dollar goes a long way today, but there's real growth in America right now.
A couple of things left, product, but first I want to talk about midterms. So normally, historically, if you look back, the end of time really, the midterms don't really affect things in any large way, but we usually have a bounce in the market the following year. It doesn't matter who's running things, but we're in unprecedented territory. I don't know what things affect other things now because nothing really makes sense, but looking at the midterms, how do you see them affecting anything going forward?
We've talked about it before. I think you had another guest on from Invesco. Yeah, from Invesco that talked about it. It's noise, in my opinion. It's almost an excuse to maybe lighten up some positions. I think going into midterms, and I've been saying it for months and months and months now. I think we have that correction. Call it late July, August, September, October going into. The midterm's going to be a bear market. But you have two fronts. And just to remind all our listeners or those that may not have listened to previous, anytime you have a new Fed chairman, especially with the changes that are coming, the market's going to want to see how that plays out, so they're going to test them. So we have a new Fed who's changing the rules, right? He's looking to reinvent how the Federal Reserve works, less communication, changing some of the data points that they look at, and then you have midterms, which right now, obviously Republicans control House and Congress. At least one will flip, whether that's the House or the Senate. I don't think they both flip, but at least one does, which is a stalemate. So I think any weakness going into the midterms, whether it's because of the Fed or the midterms, is a buying opportunity for year end. We just talked about valuations. You probably want to be long going into the end of the year and then 2027. When you're looking at talk product, we're talking about, we're bullish, right, on the equity markets. The fixed index annuity is not an equity replacement, right? But what it can do is provide a backstop to where if we do have a bigger correction or a bear market that starts that we don't foresee, it's principal protected. When we look at the fixed index annuity, it's your CD alternative, your money market, your MYGA alternative instead of a fixed rate, get upside in the marketplace. So when we look at it, if the 10-year Treasury right now is at a 4.3, and we've got S&P, triggers, caps, whatever it is. Look at the Annexus Build Americo product, straight S&P. S&P trigger, S&P's up 0.01. You get 6.5, 7. I'm not up to date on all the par rates and caps, but just call it 7% on the trigger. The cap's at 9.5 or 10 on products. That's a lot better than your 4%, corporate bond or treasury, whatever it may be. We just did an analysis for a client, doesn't like paying Uncle Sam taxes, none of us do, but they had about $600,000 in CDs getting 2.5%. Why not either ladder a MYGA or even better, put some in, a 3, 4, 5 year laddered MYGA, which is getting, 4.5 to 5.5, and then put the rest in a fixed index annuity, defer the taxes, right, and then get 7 to 9% if the S&P does better in the second half of the year, 27, 28. So use the fixed index annuity to be more aggressive in the equity markets is the long-winded answer to what I was going to say. So you have the backstop of 20, 30% in the fixed index annuity, principal protection, buy small caps, buy S&P, buy Mag 7, buy IGV, which is a software ETF, and knowing that you have that backstop where if market keeps going up, you're going to do better than your fixed income or CDs or money markets.
And then have a look at that Americo product. That's going to be good stuff.
Yeah, straight S&P, really solid product.
All right, everybody. Well, thanks for watching. This has been More Market Insights, a monthly conversation with Andy Moore, Vice President of Advanced Planning and Portfolio Solutions, also known as the Nostradamus of Scottsdale, Arizona.
Happy 250th birthday.
Oh, yes, it is. That's right.
Yep. Red, white, and blue today.
It's July 4th weekend coming up here. Oh, good Lord. I've got to get ready.
Don't overindulge, everyone.
Coming from him. Interesting. Thanks for watching.